Peter, good to have you on the program. First off, your reaction to the S&P downgrade.
Well, obviously we were surprised by the timing of it, but S&P had done a lot to signal that they were going to, there was a risk that they'd be downgrading the U.S. It did take us by surprise in that sense and the timing, but we'd done a great deal of planning so we'd be in a position to manage our clients' money at the start of this week prudently. So a bit of a surprise, but on the timing, go ahead.
I wanted to jump in because I'm all excited about what's happening on the markets. We're seeing a big sell-off right now in U.S. stock futures, as you see, down 2% across the board. Also, Asia looking set for slamming today. Are you surprised at all by this reaction in the markets?
Well, no, I'm not surprised. I think the S&P rating change, their action on Friday, is a signal to a lot of investors, a wake-up call about the level of risk there is in the world. It doesn't change anything about the level of risk in U.S. Treasuries. The fiscal outlook of the United States has been known to us all for some time. S&P's opinion doesn't change the facts, but it does change this signal to investors. So there are a number of investors out there who will view this as one more risk in the global economy, the European debt crisis, the risk of a slowdown in the U.S., take it as one more risk and use it as a signal to them that they should be reducing their overall risk. And thus, they're not selling treasuries, they're buying them, but they're selling equities and other risk assets. So that's creating some of the volatility we're now looking at.
That's right. Do you see this as a knee-jerk reaction? Do you expect, I guess, recovery and buying in at these lows?
I think it's undoubtedly a sort of an automatic reaction. Some investors are just responding viscerally and wanting to reduce their risks. Others are anticipating mechanistic selling they think will take place. So there's always a bit of churning at this moment. At BlackRock, as I said, we spent some time preparing for this. We're not mechanistic sellers or buyers of any assets here. We're not just automatically following through on something S&P has said, but we are managing our clients' portfolios and managing risk and looking for opportunities that this volatility creates.
And isn't it interesting that with the Standard & Poor's downgrade that investors will run to the safety of U.S. Treasuries, hence the yields at record lows, and also back into the U.S. dollar?
Well, I think that's the irony of a pretty marginal downgrade. If you think about it, taking the U.S., while it's surprising, it's never happened before, S&P is still rating the U.S. AA+. So the risk that the U.S. will not be able to pay its borrowing and repay its borrowing is pretty marginally decayed. Most investors use more than one rating, use 2 or 3 ratings. So this really doesn't change the rating of the composition of most investors' portfolios. There are some for whom it does change it. But clearly, coming in the fragile markets we've had with the sell-offs in the last few weeks and worries about growth, it's one more straw that may be breaking the camel's back in the sense of investors feeling a need to reduce risk, which leads them to sell their riskier assets.
I guess, Peter, the concerns on the markets was that if S&P downgraded the U.S. debt rating, this would automatically trigger some portfolios to have to buy AAA-rated securities other than U.S. Treasuries, and we're expecting a sell-off. Do you think that's actually going to happen, or is that overblown concerns?
I think that's probably overblown. First off, before the downgrade, U.S. Treasuries represented 60% approximately of the AAA universe, maybe a little bit more than that. So it would be almost hard to conceive of everyone selling those and buying the other AAAs. But the U.S. Treasury market isn't just a credit risk. It's a liquidity pool. It's a market with great price transparency. So there are lots of other reasons people hold U.S. Treasuries, and they're not about to change them just because of the rating downgrade. So I think there probably is a little bit too much overreaction to a mechanistic response.
Okay, Peter, one more question for you. As a portfolio manager, what are you doing with your money? Well,
my advice to myself and others is to not change our behavior abruptly. We don't think investors should be doing that here. It is a change, but let's look for the opportunities. So we've already for some time been up in quality and up in liquidity to try to brace ourselves for some of these shocks. And now we'll wait and see if there's some volatility. There may be some good opportunities ahead. That's what we're looking for.